Slott, the new retirement savings time bomb, how to take financial control, avoid unnecessary taxes, and combat the latest threats to your retirement savings. A thrilling retirement might seem far off, but ensuring a financially secure future requires understanding the complexities of U.S. tax law. Slott's The New Retirement Savings Time Bomb equips you with the knowledge you need to take financial control, avoid unnecessary taxes, and protect your retirement savings from potential threats. This summary will delve into the history of tax law, the consequences of small changes in legislation, and various strategies for managing your savings. Moreover, prepare to learn about the significance of IRA distributions, the benefits of Roth IRAs, as well as important estate planning tips to safeguard your legacy.
History of U.S. tax law. The history of the United States is filled with significant events and exciting moments, but one important story often goes unnoticed: the history of U.S. tax law. Small changes in tax law can greatly impact your retirement plan. The 16th Amendment introduced a modest 7% tax in 1913, but today the rate hovers around 37%. Understanding the intricacies of this system is crucial for retirement planning. Changes in the tax code greatly affect the amount of money you get to keep, and most people don't pay enough attention to this. For decades, saving through personal retirement accounts like individual retirement accounts, IRAs, has been a standard practice. However, the new Secure Act brought changes to how the money in IRAs is taxed. Saving for retirement and avoiding higher taxes requires an understanding of the ever-changing U.S. tax law. Managing retirement savings. When retirement is around the corner, it's time to start considering the options for managing your retirement savings. Whether you have a substantial amount saved up or a modest sum, there are 4 main strategies to consider, each with different tax implications. If you're like many people, you've been depositing money into a company retirement plan and have accumulated a sizable nest egg. When you retire, resign, or change jobs, you'll have to decide what to do with the money you've saved. Should you leave it where it is or consider other options? There are 4 general strategies to consider when managing retirement savings. The first involves leaving your money alone. However, some companies may require you to move the money into an IRA. Transferring the funds is tax-deferred, so you don't have to pay until you start making regular withdrawals during retirement. You can also withdraw money using a trustee-to-trustee transfer or perform a rollover, allowing you to withdraw your money and deposit it in another IRA without being taxed. Alternatively, you could take a lump sum distribution and withdraw your savings from your retirement account. However, be aware that distributions are taxed, with the exact amount varying based on your unique circumstance. In general, expect to be taxed around 20% or more if you're below retirement age. Another option is to convert your savings into a Roth IRA, a special fund that isn't taxed when you start making regular withdrawals in retirement. To reap this benefit, you must pay taxes up front on your Roth deposits. While this may be a tough deal at first, it could save you more money in the long run, the ultimate goal of retirement planning. Managing your retirement savings can be overwhelming, but understanding the available strategies and their tax implications is crucial. By carefully considering your options, you can make informed decisions to secure your financial future. Navigating IRA distributions. The rules for withdrawing money from an IRA can be complex, but staying on top of them is crucial for retirement income. Annual distribution size and tax percentages are impacted by age, savings level, and various factors. Withdrawals made before age 59.5 incur an additional penalty, except in certain circumstances. A required minimum distribution must be made after reaching the required beginning date, which for most people is after they turn 72. By using the IRS Uniform Lifetime Table and recalculate the number each year, retirees can ensure a steady flow of income during their retirement years. Stretch your IRA. Estate planning is vital as we cannot take our earthly possessions to the afterlife. Passing on an inheritance involves complexities, such as designating beneficiaries. With the Secure Act of 2019, things have been made more complicated. Only eligible designated beneficiaries, EDBs, can stretch IRA and must be designated before death. Non-eligible designated beneficiaries, NEDBs, must withdraw all IRA funds within 10 years, with a 50% tax penalty on remaining funds if the deadline is missed. EDBs have an advantage as they can draw down the account more slowly, making it grow tax-free. It is vital to understand IRA distribution rules to help heirs maximize their inheritance. Invest in a Roth IRA. Discover how a Roth IRA can help you save on taxes and enjoy more financial freedom in retirement. Are you looking for a way to make your retirement years truly carefree? Look no further than a Roth IRA. Unlike traditional IRAs, which may have you paying taxes on your money when you need it most, a Roth IRA gives you the benefit of tax-free distributions in your golden years. It may sound backwards to contribute your hard-earned money to a retirement fund you'll be taxed on now instead of later. But for most people in higher tax brackets during retirement, it can actually save you a ton of money overall. Simply put, the Roth IRA plan is worth considering if you want to pay now to save later. You can begin contributing to a Roth IRA by making annual contributions of up to $6,000, as long as you make less than $125,000 annually. Additionally, you can perform a conversion from a traditional IRA to a Roth IRA. You'll owe income taxes on the money you convert, but the long-term savings may prove to be worth it. It's important to keep in mind that once you make the move to a Roth IRA, you can't go back. But with tax-free distributions available after age 59.5, you'll have the peace of mind that your retirement savings are secure. So, if you're looking to fund your leisurely life in retirement without worrying about taxes, look into a Roth IRA. Securing your legacy. Baseball legend Bill Buckner's mistake and retirement blunders were used to illustrate the need for securing your legacy through investment in life insurance policies to avoid costly estate taxes. The ILIT method was proposed as a useful tool for keeping your hard-earned cash for your loved ones by transferring your wealth into a fund that pays for life insurance premiums. Protecting your wealth after death. Estate planning can save your heirs from losing their inheritance to high estate taxes. The $10 million tax exemption is portable between spouses, and gifting your estate before death is an option. Setting up a QTIP and IRA trust can also help secure your savings for your designated beneficiaries. Dan Duncan, a successful Texas oilman, died in 2010 with a net worth of $10 billion. Luckily for his heirs, Congress had just eliminated the estate tax, allowing his children to inherit his fortune in full. However, the estate tax has since returned, with Duncan's heirs now having to pay the U.S. government around $4 billion if he had died today. Although most people may not have to worry about paying such a hefty fee, it is still important to understand the basics of estate planning to have a say in how your savings are spent after you die. The estate tax determines how much your heirs will pay to the U.S. Treasury when they inherit your assets, with a current tax rate of about 40%, applicable to individual estates valued at more than $10 million. Knowing the exemptions can help protect your savings. For example, the $10 million tax exemption is portable between spouses, effectively protecting their wealth up to $20 million. Gifting your estate before death is another option, with a gift exemption that allows you to transfer up to $10 million tax-free. Other strategies to secure your savings include setting up a qualified terminable interest property, QTIP, trust that allows your spouse to access funds while ensuring that excess money goes to your designated beneficiaries after their death. An IRA trust can also be set up to distribute money to your beneficiaries in predetermined amounts that you decide, ensuring your savings are managed as intended. In conclusion, estate planning is essential to protect your wealth after death and should not be ignored. By knowing the exemptions and utilizing strategies like gifting your estate, setting up QTIP trusts, and IRA trusts, you can secure your savings for your beneficiaries and help them avoid losing their inheritance to high estate taxes. Essential retirement planning tips. Planning for retirement is crucial to ensure that your savings will last. This summary provides 5 essential tips to secure your retirement and offers solutions to common mistakes along the way. While it is best to stick to the plan, unexpected situations may require you to make changes. The summary talks about ways to correct your mistakes before they become bigger problems. One issue highlighted is early IRA withdrawals, which can incur penalties. The summary offers a solution known as annuitizing. Other problems such as failing to take your required minimum distribution and complex rules and regulations of IRA can also occur. The best way to tackle these problems is to have a seasoned tax expert to sort out any potential issues.
With the new retirement savings time bomb, Slott provides essential guidance to navigate the intricate world of retirement savings. By understanding the ever-changing U.S. tax law, keeping an eye on IRA distribution requirements, and designating the right heirs, you can secure your financial future. Considering Roth IRAs, life insurance, and estate planning strategies helps you maintain control over your hard-earned wealth. Remember, knowledge is power. By staying informed about taxes, investments, and exemptions, you can make the best decisions for your retirement and leave a meaningful legacy for the next generation.